So we are fortunate to have another FCA, a veteran in the space. He's someone I so much respect. He's very humble. He's got a lot of wealth of knowledge and he's always willing to share. And he's someone that, like I said, is an FCA. It's not a walk in the park to become a fellow of the Chartered Institute of Accountants. So I'm going to quickly hand over to him. His name is Mr. Adesoji, Mr. Joshua Adesoji. Yeah. Apologies, I called your last name first. And so without taking much time, because there's a lot he's going to walk us through, as you can see on the slide, the title of his session, I don't want to take any much more time. I'm going to turn off my video. I'll be in the chat section. I'll be ensuring that if you ask questions, we make sure he's aware, maybe later towards the end or whenever he wants to take the questions, he will take them. But feel free to ask your questions as it goes on. So, Mr. Joshua, it's a pleasure to have you, and I'm handing over to you right now. Thank you very much.
Thank you so much, Mike. Good afternoon, everyone. I'm sure you can see my screen right now, right? I'm trying to project. Okay. Yes, thank you so much. It's been a pleasure. It's a great pleasure and opportunity to be in this session this afternoon. Let me say, I count it as a great honor to be here. Two words about humility. You know, when you said Joshua is humble, without minding words, without playing to the gallery, I learned a lot of humility from Michael Olafusi as well. And that's the truth. Knows so much, but doesn't show it at all. And that's a story for another day. And that's just the honest truth. Now, I want to welcome everyone to the session for today. And as you can see, it's hands-on integrated financial statement model for a sample startup company. Okay, emphasis, sample startup company, that's the emphasis. Now, the reason I actually chose this is because in the world of financial modeling, the integrated financial statement model is actually the foundation for almost all types of other financial model you talk about. Is it mergers and acquisition? Is it leverage buyouts? You still need to build an integrated financial statement model. Now, time will not permit us. We have just 1 hour, or barely 1 hour, you know, to quickly go through all this. And like I was discussing with Mike, prior to the official opening of the session today, if this should take more than 1 hour, we might actually look at doing a second part. But let's see how it goes. Now, it's not a class about start talking about, you know, what the nitty-gritties of financial model, so to speak. A lot of speakers, respected speakers that came proud to today have actually done justice to that, okay? But I will still try as much as possible to run through a few slides so that we can actually go through that as a kind of a refresher, use it as a basis for what we actually want to work on today. All right, so this is just a few things about me. And yes, well, quite a few things. Let me just say, I started my certification journey when I started working with the likes of Michael and Co. And that's just the fact, that's the truth anyway. So here I am. I have a strong background in accounting, but I hardly do accounting nowadays, okay? Much more into the tech space. Anything analytics turns me on, okay? All right, and yes, I'm also a fan of Liverpool. I'm a lead consultant in Biologic Solution. I'm a Microsoft certified trainer. I'm also certified in using Power BI, that's a data analyst, okay? And other things. But let's move ahead. So let's quickly look at a glance.
Okay, sir, that you can minimize it. I can see it's trying.
Oh, okay. Yeah. All right, great. Thanks so much. All right, so at a glance, what are we trying to look at today? Now, we're going to look at introduction to financial modeling and types. I know we've done this. I'll just quickly rush through this. And the building steps and best practices in financial model, or building in financial model, or in financial modeling. Then how is spreadsheet actually different from a financial model? Not every spreadsheet schedule is a financial model, okay? But we build most 90% of our financial model using a spreadsheet. I didn't say Excel. I said spreadsheet. I'll come to that later. Also, we're going to look at a hands-on project, and fortunately or unfortunately, we're going to spend a lot of time with the hands-on project. I'm going to take us through a sample company that is just starting, building the assumptions, building the working files, working on the integrated financial statement, the income statement, the cash flow statement, and the balance sheet, linking them together and building a scenario, changing the scenarios and seeing the effect on our cash flow. Okay, so we're going to spend a lot of time there. And then finally, we're going to take our questions and answers. Okay, so this just quite a few of what we're going to look at in a summary form today. So let me quickly start. Yes, this is where we all start. What is financial modeling? A lot of definitions, a lot of solutions, a lot of definitions from people I've met. Some I agree, some I don't agree, some I don't understand. A lot of them even on the internet. So I've picked quite a few of them to just quickly look at. Some of them are a mystery to me. Some are highly philosophical. Some are so complicated, and some are quite simple and right. Okay, so what is financial modeling? Just like I said, some are so complicated. Now, I've seen this before. A financial model is a representation. This is a typical definition of a financial model. It's a representation of behavior or real-world observations through mathematical approach designed to anticipate range of outcomes. In a sense, this actually almost makes sense to me. It's very complicated. And Albert Einstein said something, said, if you can't explain it in a very simple way, probably you don't even understand it yourself anyway. So this is very, very technical. Now, some definition of financial model are so philosophical. I've seen this before, that I've seen this definition before, saying financial model is a numerical story. I've seen this definition before, but it's wrong. Forecasting wealth by putting money away now or investing. No, that is not financial modeling. But in a very simple and shocking way. You know, financial modeling is just all about inputs and outputs. Input variables, input assumptions, and the outputs, the results, the reports. Okay, that is what financial modeling is all about. Your input, the process, and the output. That's the reason we do financial model. We want to be able to predict the outcome. And I'm also very concerned or very, very careful when I'm talking about using the word prediction. I don't normally like using the word predict, because financial modeling normally is an estimator, not a predictor. You're not trying to predict to say, you know what, this is what is surely going to happen. No, you're just trying to estimate. I know we use the word interchangeably at times, but I'm always very careful not to use the word, or to use the word predict as careful as possible. Okay, so simply put, financial modeling is all about what? Input and output. Input, we're talking about the assumptions, the historical financial statements you are going to use, the variables, and the process, we're talking about the formulas, the functions, at times macros. And I'm always very, very careful. I am not an advocate of those who use macros, no matter how simple or heavy it is in financial modeling. I belong to the school of thought, or to the school of practitioners that believe that you can do almost all your financial modeling without using a macro or without using macros. So it's all about input, process, and what? An output. And the output is the report, the financial statements, okay, that you want to predict, that you are trying to estimate, or that you are trying to forecast. So simply put, financial modeling is all about inputting, using the process on the input, and getting your output or your results or your reports. Okay, so I won't lay too much emphasis on this, because I know previous speakers have done a lot of justice to this, but I just don't want to, for the avoidance or for the benefits of those who are just joining us for the first time, I just want to take this from the scratch, but as fast as possible. Now, I saw this somewhere on the internet, the definition of financial modeling. I can't really remember. It says a financial model is a tool that is built in Excel to forecast the business financial performance into the future. I agree, but not completely agree with this definition. There's nothing wrong with this definition technically, but I have some not doubts, but I have some problems with this kind of definition. Number one, the word Excel. A financial model does not necessarily need to be built in Excel. Okay, let's not deceive ourselves. I'm a Microsoft product evangelist. I loved almost everything Microsoft. But hey, Now, there's a saying that says, keep your friend close, but your enemies even closer. If you think Google Sheets is nothing to write home about, then you are probably living in a castle built in the air. Google Sheet, I'm here to talk about Google Sheet today, but Google Sheet is a fantastic spreadsheet. In fact, most of the powerful functions we have in Microsoft 365, like the filter, sort by, they were already in Google Sheet before Microsoft actually incorporated this into their array, or let me say into their resource of functions. So don't ignore Google Sheets. So that's why I'm not really in agreement with his definition. There's nothing wrong with the definition, but the word Excel there to me is too myopic, okay? So a financial model is a tool that is built in Excel to forecast a business financial. I love the word forecast. I prefer forecast to predict. So to forecast the business financial performance into the future. Now, guess what? This is my own definition of financial model. A financial model is a structured schedule, okay? It's structured. It's aligned. You know, when I say structured, there's input, there's the process, there's the workings, there's the assumption, and there is the output. They are all structured, well aligned, well put together. So it's not just a spreadsheet that has a schedule. No. So it's a structured schedule prepared with a spreadsheet. You can see I'm very careful there, the word spreadsheet, okay, not just Excel. Now, the reason I actually highlighted the word spreadsheet there is because, yes, I know we have a lot of softwares out there now that you can actually use for your financial modeling projects, and they are not a spreadsheet. Take, for instance, I know of Modano, I know of MapleSoft, I know of Contracts, okay? Now, whether we will move from the era whereby we won't use a spreadsheet completely and we start using ready-made applications for financial model is a story for another day. But believe you me, sincerely speaking, and in my own opinion, I don't think a time will ever come whereby you will avoid using a spreadsheet for the sake of using an application or a software that is specially made for financial modeling. I don't think that we ever come to be, because Excel has come to stay, and that's a story for another day. Anyway, so financial model is a structured schedule prepared with a spreadsheet for the purpose of determining the future outcomes or results of financial transactions. It could be financial statements, which is what we are looking at today. It could be projects based on several variable inputs that have influencing assumptions. These assumptions, they influence your outputs. Okay, that's what I'm trying to talk about here. And this is my own definition. Trust me, you can search on the internet, you won't see this. Anyway, if you see this, that means maybe probably I'll post it on the internet. I just sat down and say, okay, what actually is financial model? From my understanding, from what I've learned from others, I was able to understand and put this together some years ago and say, okay, this is what financial modeling actually mean. Okay, so a financial model is not, like I used to say, a financial model is actually generic. You can have all kinds of financial model. You can have a salary appraiser financial model as long as it has some or many of the characteristics of what makes a model. And you're going to see that in a short while when we look at the difference between an ordinary Excel spreadsheet and a financial model. What is actually the difference? We look at that in a short while. So what are the uses of financial model? We have so many uses of financial model. Use it to raise when you want to raise a capital. When the company wants to raise a capital for business acquisition or business expansion, when you want to sell or divest from a business to manage a risk, you want to look at business valuation. When you talk about this here, which is a very popular what's called valuation method for capital allocation and for budgeting and forecasting. And this is not just this is not conclusive, it's not exhaustive. These are just some of the uses of financial model. And I've tried to put here the building blocks of a financial model, especially when you want to create an integrated financial model, which involves your income statement, your cash flow, and your balance sheet. These are just some of the primary steps. This is not exhaustive anyway, that you can actually follow in building a financial model. The reason I'm not going through this that much is because previous speakers have actually talked a lot about this. So I'm not going to waste time going through this, but I'm just using it as a point of foundational building because I don't want to just go straight ahead I'm building a sample financial, integrated financial statement for a sample company. That's why I just, okay, let me just quickly do a kind of recap. So this is just like a kind of recap. And I hope it actually helps. So what makes a spreadsheet different from a financial model? Not every spreadsheet schedule, no, not every spreadsheet file that actually can pass for a financial model. Take for instance, if I prepare a salary schedule, that does not make it a what? A financial model. Even if I prepare a kind of maybe a loan amortization schedule, it might not really be a financial model, except maybe I create an assumption that is linked with that schedule, such that the assumption, when I change the assumption, I can actually see the impact on the amortization schedule. And I create a report based on the amortization schedule. The report will actually encapsulate the things I want to see, the KPIs I am interested in, within the confinement of that model. Then I can start saying this is a model. I can change, I can play with the assumptions, with the input, then I can see the impact on my output. Then that makes it a financial model. So what are the things that actually makes a spreadsheet, okay, different from a financial model? Number one, a financial model is well structured. It's not just a list of data. It's not just a combination of rows and columns of data. No, it's well structured. When I say it's well structured, a typical financial statement model, we have a cover page, the first sheet. The second sheet probably will be the income, the input, and the assumption sheets. Then after that, we have the workings sheet where you have all your workings. Then the last worksheet, or maybe let me say the next worksheet, will actually be your report or your output worksheet, which actually takes all its input from the workings. The workings sheet takes all its input from your assumptions. Okay, so all these are ways to actually build a financial model in a structured way. Okay, so this is what makes a financial model different from just a spreadsheet. Also, a financial model is dynamic. You change anything in your input, it goes straight to the process, which is a working sheet, and automatically it is also linked to your output. This is a very, very important concept in a financial model. It is dynamic. Also, a financial model is more often than not a forecast, is always looking into the future. And permit me to say, and I stand to be corrected anyway, there's hardly a financial model you do that you are not trying to look actually into the future, that you are not trying to actually forecast. And when I say future, hey, let's be very careful about the future. When I say future, you do know future can actually mean tomorrow. Future can be next month, can be next year, can be next 10 years. Future can be next 2 minutes. For a company like Amazon, okay, the process, or let's say the processes thousands, if not millions of transactions on a daily basis. The future is not tomorrow. Hey, the future is the next few minutes, few hours, because they rely heavily, okay, on what is actually happening to be able to predict, to be able to forecast, so to speak, to be able to determine what is going to be the tide, the flow, the trend of what is going to happen in the next few minutes, few months, few days, okay? So financial model, being different from spreadsheet, is more often than not looking into the future. Almost every model is being done, is being created, is being built for the sole purpose, or for one of the reasons, for the purpose of forecasting into the future. So this is another very valid point that actually make a financial model different from a spreadsheet. And also, a financial model contains hypothetical outcomes, and that's what I call a scenarios. This is where you put 1, 2, 3, 4. It could be 2, it could be 3 input variables together, and when all these variables change at the same time, okay, with different scenarios, when they change at the same time with different values, so to speak, you can see the effect on the output of your model. This is what we call a scenario. You are not looking at one variable. You are not looking at one factor. You are not looking at one assumption. You are looking at a combination of assumptions, a combination of factors, a combination of variables. I want to say, if these variables that are put together in a block, if they change, right, what is going to be the effect on my output? What is going to be the effect on my model? This is a scenario. This is one of the things, or these are some of the things that actually make a financial model different from an ordinary spreadsheet. And Having said that, let's quickly look at what makes a good modeler. Yes, the list is not exhaustive, but hey, trust me, these are very, very important. Number one, finance. You must have, you may not, I'm not saying you should be a finance guru or an MBA graduate or whatever, but you must have a good understanding of how finance works. That's true. Then accounting. Accounting is very important in being a financial modeler. I'm not saying you should be a chartered accountant or a qualified accountant, but you must know how accounting works. Especially, you must understand the accounting equation that assets always equals liabilities and equity. I'll take you through. I did some kind of schedule on that, which I'm going to share with us. So accounting is very important because most of the models, especially the integrated financial models and all some other related models that actually take their foundations from the integrated or three-statement financial model, they are very key. They are very key. I mean, accounting is very key to the understanding of such financial model. Okay, so accounting is very, very important in being a good modeler. Also, the economy, you must understand how the economy works. Now, the reason I said this, or the reason I put this here, is because when you're working with a given financial model, take for instance, I'm working presently maybe on a poultry financial model for an SME client. I must understand how the economy can impact on that particular business. So that is why understanding the variables in an economy is also important in you being a good financial model. You don't need to be a guru, but you need to understand some of these things. Yes, and very important, you must know something about your spreadsheet. Now, you see, I'm very careful. I'm not just saying Excel. Yes, you may decide to say you want to go with Excel, no problem. Yes, a very good understanding of spreadsheet is very important in being a good modeler, because most of the time you're going to spend lots of your time working on the spreadsheet and building your financial model using the spreadsheet. You don't need to be a spreadsheet guru to be a good modeler. Trust me. Just need to know how it works, cell referencing, a couple of things, then I believe you're good to go. Also, you must be very analytical. You must be able to analyze. You must be able to know the impacts and how input actually impacts on the output. You must be able to analyze. You must be able to see the effect of input on the output, how variables can affect your KPIs and so on and so forth. So you must have that analytical capability to be a good modeler. And finally, you must be very good in that particular subject matter. Every financial modeling is unique, even if it is for the same repeated sector of the economy. There will always be something unique about that particular financial modeling you're actually working on in that particular time. So you must know about the subject matter. Take, for instance, you're working on financial modeling in an oil and gas. That is a very, very specific area, different area in financial modeling that is specific to the oil and gas. You must understand the business model. You must understand the cash flow model in an oil and gas scenario or environment. Okay, in an oil and gas scenario, an oil and gas financial modeling is extremely different from, let's say, maybe a banking financial model, because they have different kinds of financial modeling. Let me say they have different kinds of business model and how they generate their income. So you must understand the subject matter about that particular project that you're actually working on. So when you say the subject matter, you must understand that particular subject, the particular organization, the particular sector that you're actually working or creating or building that financial model on. So these are just something. This is not an exhaustive list. This is just what I believe over time from what I've learned, and I'm still learning, that I believe are very, very crucial and necessary for you to be a good modeler or a good financial modeler. Now, so having said that, before we move, this is the last slide before we actually move to the exercise or the project for today. We are going to build a three-statement financial model, and these are the important aspects that I actually want us to look at. Number one is a startup company. So it's not a company that is actually already operating. When a company is already operating, or let me say a going concern, or a company that is already operating, I can actually make use of the company's historical financial statements and use that to actually do what? To forecast into the future. So there's nothing to use that we are relying on here. There's no historical financial statement. So it's a startup company. So we're going to rely a lot on assumptions, okay? And having said that, it's a typical bread baking company. I got this idea because a friend of mine who is also into financial modeling just started a baking outfit of recent. So I said, why not? Let me just use this as an example in the session I'm actually going to work on today. So this company, this sample company, also has equity and debt. The model is going to be, we're going to build an income statement, the cash flow statement, a balance sheet. Also, the templates have been prepared to save time. I prepared all the templates, everything. I've worked on that so that we won't start preparing the templates. Trust me, if we need to start preparing the templates and all those stuff, of course, that's going to take like about maybe 2 to 3 hours. And also very important, cell referencing. Of course, we're going to make use of that a lot in modeling. I want to believe you already have an understanding of that. If you do not, please check up Google cell referencing. And I'm sure you have more than enough reference materials on the internet that you can actually read to get yourself acquainted with cell reference, because we're going to use that a lot as in making cells absolute and maybe relative. And also we're going to do a lot of cell linking, or let me say sheets linking. I'm going to be linking one sheet to the other. So these are some of the things I believe are going to be very, very important in the financial modeling and some project that we're going to work on in the next couple of minutes. So without any question now, which I believe maybe we take at the end of the class, let me just quickly delve in straight into what we have. I'm going to take you through what I have. This is the file. I prepared the schedule. I prepared the templates. Okay, all I need to do is just look at the assumptions, plug in the assumptions, plug in the workings, create a financial model, work with the scenarios, change the scenarios, and let's see the effect on the financial statements that we are trying to build. Okay, so this is a 3-statement financial model or integrated financial statement model that we're trying to build. Now, I have 4 sheets here. The first sheet is my startup requirements, okay? And if you look at the startup requirements we have here, we have debts, we have equity. So this company that is into bread baking, bread baking, actually got a debt of 1.5 million naira and raised an equity of 3 million naira, that's 4.5 million. And from there, they bought inventory that they're going to use to make the bread. The inventory is worth about 1,050,000 naira. They got a molding machine for 2.285 million naira and furniture and fittings for 915,000 naira. So you can see the liability plus equity actually equals what? The assets. Now, this is a very important concept in accounting. We call it accounting equation. Accounting equation says assets will always equals your what? Your liability and your equity. Assets don't fall from heaven. When you are starting a business, developing a business, your assets is a function of 2 things. It's either you borrow to acquire the assets, or you invest into the business to acquire the assets. Now, time will not permit us to go through all this. I actually prepared this yesterday to show the impact. You know, a lot of people who don't have a accounting background will find it very, very difficult to understand, because the most important thing, the biggest check in your integrated financial statement model is that your balance sheet must balance. Assets must always equal liabilities plus equity. That is when you can now breathe a sigh of relief and say, now I believe. That doesn't mean you don't still have maybe some kind of errors, but at least you can rest assured that you've done the right thing to a large extent when your balance sheet balances. Now, these are transactions, events, and their effect on assets, liabilities, or what? Or equity. Time will not permit me to go through this, but I'll make this available through the organizers, and they can actually share this and distribute this to anyone who is interested to actually have this at the end of this session. Okay, so let me quickly go back to where we have. So this is the file we're going to use to build our model. So we have the requirements. So these are our requirements. So to make your job very easy, you must plug in all your assumptions. Okay, so these are the assumptions. This company is going to acquire a debt of this. invest 3 million in the business, and this is how they are going to actually spend. You can see when I was talking about this the other time, I didn't even mention working capital, the working cash. I didn't. You know why I didn't mention it? Because when the company acquires these debts and they raise this as equity and they spend this on spend 1 million to acquire inventory, 2.2 million 85 to get the molding machine, and to spend 915,000 on furniture. The balance is actually the cash on hand. So that's why I didn't even mention that. So this is just like the balance of cash on hand after spending all this from the 4.5 million naira that the company has been able to raise with the combination of debt and equity. Now, the next worksheets are my assumptions. Very important. You can create your assumption any way you want it, but make sure you've done it in such a way that they are they're very, very easy to reference. So I can easily reference this assumption worksheet here. So what do we have here? I will come back to the scenario case later. So these are my assumptions. If you look at my assumption here, now we have assumed that this company is going to be selling 300. Let me delete this. 300 bread per day. Okay. Now they're going to be selling big bread and a small bread. Big bread, they're going to sell 45 units, and a small bread, it's assumed they're going to sell 55 units. Okay, and these are the prices. Okay, so the big bread is going to go for 350 naira, and the small bread is going to go for 150 naira. Okay, per bread. Okay, now this is my cost. Okay, the cost is made up of flour, water, sugar, whatever. So the cost for the big bread is going to cost us 200 naira. The small bread, everything put together, the cost is going to be 90 naira. Now we also have some other admin, general and administrative expenses. Salaries is going to be 155,000 per month. Other staff cost is going to be 25% of whatever the salaries amount is. You can actually change this if you want, and you see the effect on your model at instant. Now, the monthly rent is 85,000 per month, and the monthly utilities is going to be 50,000 naira. Interest rate is 23%, typical of a Nigerian bank anyway. And the income tax is 30%. Okay. Now, we also have some seasonal assumptions here. This company is not going to operate every day of the month. So in January, they're going to operate for 22 days, February 20 days, and so on and so forth up to December. Then the seasonal variance, the seasonality variance also has been taken as 80% for January, 90% for February. Now, all we're just trying to say here is this. See, we're just trying to put in some risk factors. We believe this company is not going to make all the 100% sales in January. They're just going to make 80%, maybe just because it's starting. In February, maybe 90%. March, they're actually picking up 100% and so on and so forth. And by December, maybe they're scaling down operation, maybe because a lot of people will have traveled. We are in festive period for one reason or the other. So you can actually change all this. But the reason is, and if you remember the other time we're talking about why what makes a financial model different from Excel is because they are dynamic, they are related, they are structured. And that's what we have tried to look at here. So these are my assumptions. I put my assumptions here. You can see bread that will be sold per day, the units and the price that will be sold. These are assumptions, the cost, the utilities, the rent, the salaries, other staff costs, and also other assumptions that has to do with seasons, the seasonal assumption, the seasonal variance, and the number of days in each month that we are forecasted or that we have assumed that the company is going to use during the period of operation. Okay, so this is a company that's just starting, and we are trying to do what? We are trying to forecast, to project an integrated financial statement for the next 12 months for this company. Okay, so that's what we are trying to do. And so this is my assumptions worksheet. So this is my workings worksheet. This is where I have all my workings. The reason I'm going to have my workings here is that anything that has to do with workings, calculations, I want to have them here. And after that, I'm going to have my financials here. Now, talking about the workings, I'm going to have my revenue workings here, where I have my bread sold per day, the average size, the number of bread sold, the big size and the small size, and the total. Then I'm also going to forecast for the sales, big size that is being sold, okay, in terms of naira, the small size that is being sold in terms of naira, the daily sales and the monthly sales. And also I'm going to try and work all my expenses here. my sellings, general and administrative expenses made up of salaries, other staff costs, my rent, my utilities. Then I have my total admin or my total XGA expenses here. This is total. Let me put it here. This total XG A. Just put total SGA expenses. Okay. All right. Then my cost of sales. I'm going to have my cost of sales here. I'm going to predict my cost of sales here. Not predict. I'm going to forecast my cost of sales here for big bread and for the small bread. I'm going to have the total here. Then after that, we're also going to work on depreciation. We've been given all this assumption. The depreciation we've been told is going to be for 2 years straight, and it's going to be flat. That means for 24 months, I'm going to have a flat straight line depreciation for the molding machine and the furniture and fittings. Okay. Then the interest rates. If you remember, this company took a loan, right, of 1.5 million here, and the interest rate is 23%, which I've linked it up to what I have in my assumption worksheet here. That's how I got this. You can see it's linked up. Okay, that is where I picked it from. So that is all about my workings, the workings sheet. Then the next one, which is the output, or the last one, is actually my financials or my output worksheet. Here I have my income statement, okay, projection. Let me show you something. I'm going to press Control down. I have my, you can see my income statement. You can see I have my revenue, my cost, gross margin, the gross margin. I've prepared all this. I won't go into what all this means. Anyway, so this is my income statement. If I move down by pressing Control down arrow, it takes me straight to my net income. Control down arrow. I'll tell you the reason why I'm saying that. You can see my title. The next on the line is my cash flow statement, okay, projection, where I'm going to forecast the cash flow that the company is going to be operating with. Then after that, I have my balance sheet. Now, the reason I said I was using Control down arrow is because I created what we call elevator jump. In financial model, if you have a long list, and before I go into that, I'm an advocate of vertical financial statement. Vertical means you have, or when you're preparing your integrated financial statement, your 3-statement financial model, you have all the statements, okay, in a sheet, and they are all vertical. You can see everything in one sheet. Not that you have them in different worksheets. I don't belong to that school of thought where you have them in different worksheets. That's horizontal. No, I like to see everything in one sheet, and that's what we mean by vertical. So what I've done here is to actually put what we call elevator jump. Now, if you look at cell A3, you can see A3. You can't see anything there because I actually grayed it out. Why? I just used a white text or font color so that you can see it. If I change it, you can see the X is there. So what did I do? All I did was to put the X or put X's in some of the cells there. So they are acting like a page breaker. We call them elevator jumps. Okay. So if I press Control Shift down or Control down arrow key, so to speak, it takes me from one what's called view to another. So I can actually see my financial statements from one type of statement to another, instead of just jumping from one page to another page endlessly. So I have the income statement, we have the cash flow statements, and we have our balance sheets. Okay. So the income statements, we don't have anything there right now. Cash flow statements, there's no big deal about the cash flow statement. If you look at what I have at the cash flow statements, for all these statements, we have the actuals and what? The projected, or yes, the projected period. Actuals, that's what we are actually starting with. The projections, January to December, that's for 12 months. For the income statement, we don't have any actuals right now. For the cash flow, I think we do. Now, the reason I've actually plugged all this in is because I just want us to have a very good understanding of what we have here. If you remember, this company actually took a loan of 1.5 million, raised 3 million in capital, then bought molding machine and furniture and fittings. Everything together is 3.2 million. Then inventory of 1.5 million. If you take this away from the amount raised, the balance is 250. So this company actually has 250,000 naira cash on hand. And if you look at what we have here, which I actually did this so that we can understand, that is exactly what we have here. So coming back to my I think working. Was it working? Oh, yes. Oh, sorry, financials. My financials. My closing cash is actually 250. Okay, so that's what we are going to use to start our projection for the next 12 months. And in a financial, in a cash flow statement, the closing cash, the closing balance for a period is going to be the opening balance for the next period. Check this out. If you look at this, I'm actually picking this from here. If I move here, the opening balance for the current period is the closing balance of the subsequent or the previous period. And that's what I actually have here. So the opening balance for a new period or for the current period is actually the closing balance of the previous period. So that's what I've actually done here. Let me take away the arrows. Great. So that's the cash flow. Then the balance sheet. The balance sheets, just like I said the other time, assets, it always equals to what? Liabilities and equity. So what we are trying to do here is that I've actually plugged in the assets here and the liabilities in my balance sheet. So very important, my balance sheet actually balance. So there is this integrity and structural test that I've carried out to show that my balance sheet will balance. So assets will always equals liabilities and equity. So this must balance. You must. This is a very, very important concept in financial model. You must always try and put some kind of integrity test to ensure that you've done the right thing. Okay, so I haven't done this. So these are the housekeeping templates I've actually prepared in advance so that we can just try and start this without wasting much time. So I've explained the set of requirements, I've explained the assumptions, I've explained the workings, and I've explained the financials template. So let's quickly start and work on the workings templates. Now, the first thing we want to do here is to forecast our unit sales. Units, not in Naira now. So how many bread were sold per day? That's going to be equals to, it comes to my assumption page. This is where I have it here, 300. I'm going to make this absolute, F4, okay? Enter. Immediately I do that, you can see I put a kind of check here. I use a combination of a formula and also a conditional formatting. The conditional formatting is a very small, I think it's a very small function I use here, very small conditional formatting, very simple rather, that says if it is not equals to 0, then I want you to do what? I want you to what was the word now? I want to actually make this to work. I want to put it on. Okay, so that's actually what I did there. All right, so 300, I can click this and drag. So that means from January to December, we are predicting that, or we are forecasting we're going to sell 300 bread on a daily basis. Now, what about the number of big bread for the number of big size bread? That's going to be 300, right? Multiplied by 300 multiplied by, I go to my assumption. What is the unit, the percentage of a big size we want to say? That's 45%. I'm going to make this absolute again by pressing F4, click that, press enter, click, drag. What about for the small size? The small size bread is going to be the total bread, your unit of bread, which is 300, multiplied by, going to my assumption, the percentage of the small size, which is 55%. Press, make it absolute. Immediately I did that, okay, you can see the error check is now what? Nil. I've been able to fulfill the integrity check there, okay? So this is the total amount of big bread per day and total amount of a total number of small bread per day. Then we go ahead and try and do the sales forecast in Naira now. So how much are we going to make the forecast for big bread per day? This is still per day. So the big bread that we're going to sell per day is going to be a function of what? The number of big bread we are selling multiplied by the price, which is 350. I'm going to make that absolute as well, so that when I click and drag, it will always refer to that single cell where I have the price. I'm going to do the same thing for the small size, which is the small size amount, which is 165 multiplied by the selling price. Make this absolute by pressing F4. That is the amount. Click and drag to the right. Sorry, shouldn't be up to that point. So this is the total daily sales. That was going to be my monthly sales. My monthly sales is going to be the total monthly sales in Naira, okay, multiplied by, let me go to my assumptions. The total number of days for each of the months in January is going to be 22. I'm not going to make this absolute, so that when I drag, it's going to pick February, March, April, May, and so on, multiplied by the seasonality variance, which is 80%. Multiply by that, and I have my monthly sales forecasted for January. Let me drag this till December. So that is going to be my monthly sales. So I've been able to actually forecast the sales for January till December. All right, so the next thing is expense. Let's quickly look at our salaries. We've been told that our salaries per month is going to be how much. I go quickly to my assumption page. This is where I have the salaries per month. This is it. Make it absolute, pin it down, click OK, click and drag. It will always refer to that particular cell. Next thing is other staff costs. We've been told that other staff costs is a function of my salaries multiplied by what? I go to my assumption page, this other staff cost. We have 25% there. I'm going to make it absolute by pressing my F4 key, so that you always refer to that particular cell. Click and drag. When I click and drag, I've been able to do that for other staff costs. What about rent? It's going to be equal to, where do I have my rent? This is where I have my rent. F4, press enter, click, drag. Okay, from January to December. The next thing is that utilities. We go to my utility, to the assumption page. This is where I have my utility. Press F4, enter, click, and drag. All right, so that it can be dynamic. Now, we are still left with the cost of sales. Our cost of sales is going to be materials for big bread. What's the materials for big bread? Number one, the big bread. How many big bread are we selling? What's the units of big bread we are selling on a daily basis? We are selling how much? This is going to be a little bit tricky. This is my big size bread, 135, multiplied by, I go to my assumption, multiply by the cost for the big size bread, which is what I have here. I'm going to make this absolute, press F4, multiply by the number of days. I'm going to make that sales. I don't need to make that absolute anyway, because I have you spread throughout. Multiply by the seasonality variance as well. Press enter. I'm going to do the same thing before I drag it. Let me just do the same thing for the small size bread. It's going to be equals to how many units of small size bread are we selling on a daily basis? 165 is in this cell here. I don't need to make it absolute because I have it spread all through. Then that's 165 there, multiplied by, I go to my assumption page. What is the cost of the small size bread? What is it costing us per unit? This is what we have here in cell B20. Make it absolute by pressing F4, multiply by number of days I'm going to use that to operate in a month. I don't need to make that absolute because it's spread through. Then multiply by what? The seasonality variance. Enter. So I can just select these two now, click and drag. Fantastic. Great. So I have my total cost of sales. All right, forecasted now. Then the next thing is, I'm going to be a little bit fast now. The next thing is that I need to forecast my depreciation. Now, of course, in a typical financial model, yes, we're going to have a different schedule for what's it called, property, plant, and equipment, where you have acquisition during the year, disposal during the year, the depreciation during the year. But this is a typical startup company. So there's nothing, we've assumed they are not disposing and they are not acquiring any other fixed asset during the period of forecast. So I've made it a little bit simpler. So 2 years, that's 24 months. Where are the assets? These are the assets. We have the molding machine. Where's my molding machine? I have my molding machine here. It's here. Make it absolute. Okay. Divide that by 24. Okay, so that means I'm going to have this amount as depreciation forecast throughout. Now, what about furniture and fixtures? Equals to what is the furniture and fixtures here? This is it here. Make it absolute, divided by 24 months because it's for 2 years. Then I can click and actually drag this up to this point. Okay. So I think, yes, the last thing we have here is the interest. I've made it very simple. The interest is just the amount we have here. Let me make it absolute because I'm going to drag it, multiplied by the debt obtained. Let me make it absolute as well, divided by 12. So this is going to be the amount we're going to be paying on interest on a monthly basis. Simple and short. No need to make it too complicated. Yes, I know in a typical or in a more complicated or more advanced financial model where you're going to have a kind of a loan amortization schedule or a debt schedule where you have all this, but I'll make it very simple in this instance. So I think we are done with our workings. Then the next thing we need to do is actually to plug in our financials. So this is our financial statements. I start with projection. Where is our revenue? Equals to, I go to my workings. Where is my revenue here? Monthly sales. Click this, select, click and drag. So that is the revenue. You can see everything. I've actually tried to, automate everything by adding what I need to add, sum what I need to sum, and so on and so forth. What about the cost? Equals to, come to my workings. My cost is, this is a total cost. No, I mean the cost of goods. This is the cost of goods here. Pick that, select and drag. Once you put in the costs, I've done in such a way that you can quickly see your gross margin and your gross margin or your gross profit percentage. The next thing we need is our selling, general and administrative expenses. I can click equals to and go straight to where I have it. This is where it is. Click and drag so I can populate for the rest of the forecast period. So this is our EBITDA, this is our EBIT. What about our depreciation? We did our depreciation here. I can just come in here and quickly link my depreciation here. This is what I have. Select, click and drag so I can have my depreciation here. What about the interest? Select, come to workings. I have my interest here. And just select this. I can click and drag. That is my interest. What about tax? Tax is a function of your EBT, earnings before tax, okay? Multiplied by, let me go to my assumption where I have the tax rate. I'm going to make this absolute, okay? So that it will always refer to this particular cell. So that is my, that is, okay? So that is the tax. All right, so I have my tax. All right, so then we have the net income, which is a function of what? Your EBT less your tax rate. All right, so we have this now. I haven't done that. We've been able to model our income statement. Let's go quickly to our cash. I've explained the concept behind the cash flow the other time, talking about the template, not the cash flow itself. Time will not permit us to even go through this at all. All right, so the only thing I see here that changed from our assumption, number one, is that we need to add back items that does not involve the movement of cash. And the first thing I can see here is actually my depreciation. So I'm going to say equals to, pick my depreciation here, enter, click, select, and actually drag here. Haven't done that automatically. This is being picked. I hope so. Is there any other thing I need to do? Assumption, no capital expenditure during the period of forecast. No debt was raised, no equity injected. And we've left other items here as is, just to make it very simple. Okay, so now let me quickly move to my balance sheet. Now the balance sheet must balance. Now is from the actual page or from the actual column, we don't have any issue. From the projected columns as well, we don't have any issue because we've not started plugging in anything. Now, what's going to be my cash at bank or our cash at bank is going to be equals to what? The closing cash balance or cash balances for all the projected period in our cash flow statement. So I'm going to link it to that. Click and drag. Stop there. All right. You can see we have error here. Okay. There's error there. Why? Because we've plugged in. So my asset must equal my total liabilities and equity. So let's just quickly go ahead and take it one by one. Inventory, we've not done anything to inventory. We just want to make it simple. We assume inventory is just going to remain and be the same. Okay, we just try to make it simple. So I didn't do anything about inventory there. We just calculated the cost of goods based on some given percentages. Now, what about the property, plant, and equipment, where we have our fixtures, furniture, where we have the molding machine? The cost remains the same because we did not acquire, neither did we dispose during the period of forecast. But what about the depreciation and amortization? This is where you need to be very careful, because the depreciation and amortization here is a cumulative, it should be a cumulative balance. And what do I mean by that? The first depreciation is going to be for, I can pick it here, for the first projected period. Then the second cumulative depreciation is going to be the previous one plus the current depreciation, which I can actually pick here in my income statement. Press enter. Then I can now click and do what? And drag. All right. I haven't done that. I think we are moving. The next thing, our balance sheet still has error, and everything here is okay before we can rest assured that we've done the right thing. Accounts payable is a startup. We've not done anything on that. There's nothing on accounts payable from the assumption. What about bank loan? It wasn't repaid, so it's going to remain the same thing throughout. So I can just select this, click and drag. Okay. Owner's equity is still going to be the same thing. 3 million, click and drag. It's the same thing. No owner's equity, no further injection of equity. So, okay. All right. So the next thing we need to do, haven't done that. Owner's equity. So I don't know. You shouldn't have balanced because I'm not even yet done. So that's owner's equity 3 million. Yes. This and is a function of these two together. Okay. All right. So let me look at what I've done here. Projection, yes. Cash balance. I've done this. We've done our cash. We've done this. Depreciation, yes. Yes. The bank loan, we've done that. Owner's equity has been done. My retained earnings. My retained earnings should be there. So I don't know. It shouldn't even balance now. My retained earnings should be equals to, because of course it should be there. This is my retained earnings equals to, I've missed something, but I'm going to find it out. My retained earnings is going to be the net income. Enter. Okay. Then the retained earnings for just like the depreciation, your retained earnings is also the cumulative amount of your profit or the loss over a period of time. So for the next forecast period, your cumulative earning is going to be your cumulative earnings, which is a profit or loss. It's going to be the previous one plus the current cumulative what's called a profit or loss, which is a net income. Okay, that's what we have there. All right, so I'm going to select this. So I've clicked this, click and drag. All right, now there is an issue. Take this minus this. So the issue is actually my retained earnings. Now, when I did this, I hope when I was putting this together, I think I remember. Yes, what actually caused this is that in my cash flow statements, yes, in my cash flow statements, I forgot to, in fact, that's the first thing I should have done. Okay, the net income should actually have been here. Put your net income here. Of course, click and drag. All right. Okay, now I can breathe a sigh of relief. The balance sheet balance. So we've been able to actually create the assumption, work on the income statement, work on the cash flow statement, work on the balance sheet. I know it's a very, very small, limited time that we've used to actually do this, and I've rushed through this, but you can always have access to the video, look at this later, and even ask questions online and even offline after this session. So we've been able to do this. Now, the beauty of this is that I can actually come here now and look at the scenario. This is the base case. You remember the other time we were working on the scenario and I said I was coming to this later. This is the scenario. So I've just taken 3 scenarios here. Number 1, the bread that will be sold per day, the rent per month, and the utilities per month. If any of these 3, right, if these 3, put them together, if they change, what is going to be the effect on our what? On our financial statement, on our model. Look at what we have here. Now, we can see that the balance sheet is balanced, no problem. But this is the base case, the base case scenario. If I should take this to the worst case scenario, you can see a lot of reds. Okay, negative net income. In fact, the cash balance is even a negative of almost ₦1 million. Okay, that's a big job for the CFO to see, or the owner to see how he's going to make due for that and make sure that that does not disrupt what's it called, the operations. Now, what about if I change this to the best case scenario? Of course, you're going to have more cash on hand and so on and so forth. Now, how did I do this? Very, very easy. All I did here was just to actually use data validation /AVV, okay, to get my data validation. Go to list, where is the source? Go into my assumption, select this. You can also type it in anyway and click OK. That is exactly, then you get this. And that was what exactly I did here. Okay. I'm very sorry. Just give me just like 10 more minutes. I should be able to round up /AVV. Let me just clear this out. So that was how I did that. Okay. Let me clear all. Click OK. I clear that. So, but how was I able to link this up? Now, the reasoning that I was able to link that up and see the effect on my financials because they are all linked together. And that's what, if you remember, when I was some couple of minutes ago, when we were looking at the difference between a spreadsheet and what makes a spreadsheet different from a model, we talked about structure, we talked about hypothetical outcome, we talked about dynamic. Okay, it's dynamic. They're all linked together. That's how I'm able to do that, and that's how it works anyway. Then if you look at the assumptions here, and that was the reason why I actually had this what in the background in orange. These are the 3 major variable assumptions I'm working with, or variable inputs rather, that I'm working with. The number of bread sold per day, you can see it here. That is 1. Monthly rent, you can see it here. And the monthly utility, also you can see it here. And what did I do? What I did was just to use a VLOOKUP to say, hey, look, if this changes to either worst, base, or best, what I want you to do using a VLOOKUP is to go straight to this table. Look at what is here. If it is worst, then the number of bread sold per day should be what? 100. If it is base, change this to 300. If it is best, change this to 500. Now, let me show you this. If I change this to worst now, let me go back to the assumption. Can you see it has changed to 100? Why? Because it is linked with a formula, and I used HLOOKUP, okay? The reason I use HLOOKUP is because of the structure of the table here. If this has been in vertical, let me transpose this and make it in this order. If it is vertical based this way, then it will have been a matter of using what? A VLOOKUP, which is a vertical, okay? I know some of you folks and say, okay, why not? You can actually use an X lookup, but not everybody's on a M365 or Microsoft 365. Okay, so that's what I did there. So I can just quickly give you an example. What I did was just, so anyway, because of time, I may not be able to actually go through that, but let me just quickly take one example. Let me just use one explain one of these input variables. So what I did was to say, okay, equals to H lookup. What am I looking up? I went to the financials. I'm actually looking up this value. I'm looking up this value here. Let me make it absolute, comma. The next thing is my table array. I go back to my assumption page. I select my table array. This is my table array. Let me make it absolute as well. So I've given the argument for what I'm looking up, the table array, which is everything I have. What is the row index number that I'm interested in? When it comes to the variable of number of bread, that is in row what in my table? This is row 1, row 2. That is where I have my bread sales per day. So I'm going to type 2 here, comma 2. That's the row I'm interested in. When I want to change the number of bread sold, then comma. Do I want exact match or approximate? Exact. False is the same thing as 0. So I'm going to put 0, close my bracket, press enter. That is how I got this. And if I come here to my financials and I change this scenario, it changes because that scenario is actually picking this scenario here is picking 3 input variables. The number of bread sold, that's why I highlighted it, the monthly rent, and what? The monthly utility. And don't be amazed that it's changing a lot of things. Why? Because if I select this, this is linked to a lot of values. If you remember and if you're following what we've done since inception, if I look at the dependents, how many cells are actually dependent on this? Okay, if I double click this, look at all the number of cells. You can see all the cells that are actually depending on this. That is why it's changing a lot of cells, a lot of things in my model. The same thing with this. How many cells are depending on it? So many. How many cells are depending on this? So many of them. Can you see? So many cells depending on this. That is the reason why if I come to my financials and I change this to worst case scenario, you can see it's affecting a lot of values there because they are all linked and interwoven. Okay, let me go back to base. And that is how I'm able to actually work on the scenario. And when I change the scenario, I can actually see the effect on my financial model, and I can see, and that can enable us as a company or as a startup company to be able to actually determine our level, our threshold of operation. You know, what's going to be the effect, how we should actually play with this, what should be the limit, how extreme or otherwise can we go with our sales per day, talking about the bread sales per day, the rent per month, the utilities per month. There is no limit to the number of input variables you can put here, but because time will not permit, I didn't want to put, I can actually involve what's it called, also include the price and even the cost here as well. And that will make it even more intuitive and even more interesting. So sorry, I've taken our time so much. So that's just how you can create an integrated financial statement for a sample startup company. I will make this available to the organizers at the end of the session so that it can actually be distributed to anyone who is interested, talking about the slides and the worksheets. Thank you very much. Mr. Mike, over to you.
Thank you very much.
Pardon me for the time taken.
No, it's you didn't. In fact, we should be thanking you for giving us more than the 1 hour we were asking for. So, any questions from anybody? Any questions before we normally ask 2 questions, so but I want to first get questions from the house. Anyone has any question, or I should go ahead and ask our standard 2 questions?
Question from anyone?
I guess maybe they all on that.
Hi. Hello, can you hear me?
Yes.
I'd like to ask if we're going to have access to this spreadsheet so we can practice on our own.
Yes, like I said, I thought Mike was going to answer that question. Yes, like I said a couple of minutes or I said that time and again that the spreadsheet is going to be made available. I actually prepared it for this session. It's going to be made available. I'm giving over to the organizer so that they can actually post it. They know how to distribute it anyway. and get it across to whoever is interested. So the answer, short and simple, is yes, you will have access to the files. The blank and the one that actually I worked on. The blank one, the solution.
Okay, so in addition, just in case you don't know where normally we try to put all the resources, make sure you join the main meetup. So I'm typing it in the chat box, so I will be able to email it to everybody from there. And also, if you go to the YouTube, I'm pasting that now. Go to the YouTube channel where we place the recording of this session. We try to also include the sources the present that we made available. So you go to those two places. In fact, I would say do the two. So that way you will not, by tomorrow this will be up. So obviously the material too will be in the comment section of YouTube. And if you join the meetup, I will also include everybody. That's the place I feel supposed to be. Thank you for that question. Any other person has a question? Yes, sir. Did you see the feedback, Mr. Joshua? So you say your session was easy to follow. Very appreciative of how you don't meet with them, John.
Thank you.
So I will move to the questions we have so that we don't take the whole of your afternoon from you. Question number one is, I really like that if you can maybe show that slide at the beginning that has your some people will be like, hey, how can I? Yes, the second one that has your all what you have. I even like that you put your football club there. Some people that are not, they are not happy with their football club. They hide it. So that's
not been.
This
I know we've not been doing well.
Yeah, this one.
Okay.
So, so my question number one is, for somebody starting, if they see this, they're like, where am I going to start from? So I want to ask you your advice for someone starting right now. How can they, how long do you think it will take them for them to be able to say they are good in financial modeling? What structure should they follow to learning? I know you mentioned that some things are really necessary in building a financial model, knowledge of spreadsheet, knowledge of finance. But then again, let's say it is someone starting out right now. What roadmap will you give the person?
All right. Well, thank you so much for that question. I hope the voice is not breaking, is it?
No, it's not. It's clear, sir.
Because I put on the panning system. All right, great. Now, number one, learning is not a destination, it's a journey. I'm not saying this to what's it called, to play to the gallery or whatever. Actually, when I joined your league, I say your league, the likes of, I got to know about you some couple of years ago, and I'm being sincere. I think it was on Meetup, and you're trying to. Yes, that was the first time you did Excel and Meetup. We did that in Microsoft office on the island. You remember?
Yes.
You know me then, anyway. Yes, that was my first time. So when I saw that, and when I saw the Meetup, I thought I knew Excel then. So I said, what are they going to do? Let me just try and let me attend, show them my stuff and whatever. I was humbled. So when I saw that, I said, then I started learning. I had to jettison what I knew then, and then I knew that it's a continuous process. You can never exhaust this. Now, coming to your question, the reason I said that is this. Number one, you need to move with people who are in this league. I don't know everything. I'm still learning. I learn every day. Trust. I'm being sincere. I'm being very sincere and I'm being very modest here. Each day, if I'm not in a training session, if I'm not taking the training session, if I'm not working on the project, I use average of about 10 hours to study in a day. Okay, and that's the truth. Average of around 10 hours to study, because now so good nowadays you can even do most of your trainings are online at home in the office. You don't need to be physically with a staff what's called the client is. So the first thing is that you need to study. You need to move with people. You don't need to know them physically. You can follow their page, you can follow their YouTube channel, you can you need to you can join groups. One of the things that humbled me a lot and made me to learn a lot of stuff again in Excel is the Excel group, the Power BI group, which fortunately you are the creator. I learned a lot of things there. Many people don't even see anything there, but they learn a lot of things there, and they are being challenged. You think something, someone comes up with something very fantastic, then you need to go back. You need to go back and start doing a lot of learning and research as well. To answer your question directly now, to learn financial modeling is not really a big deal. If you don't have, like for me, my first love is accounting. That's my strong background. Okay, for you is engineering, and there are some things, Michael, that you do that amazes me, and that's the truth. Your knowledge of financing and investing is awesome, and that's the truth. For someone like me who has a background in financing and in finance and accounting, I'm humbled. I don't know much about, until maybe recent, when we do analysis, when we meet on the investment platform, the way you analyze is, it's, I just laugh for someone who read that was called electronics. So how did you get there? You mix with people, you learn, you put it into practice. If you want to know financial modeling, yes, learn accounting. Now, there's no excuse for not knowing in this dispensation. You know why? Almost everything you need is free on the internet. So you don't have any excuse for not learning. Almost everything you need to learn, you might need to know, you want to know. Almost everything is almost free. Good stuff on the internet. So you go out there, get your hands dirty, take the time. You must invest a lot of time. So for someone who has taken a very, very sharp paradigm shift from electronics to finance to accounting to financial modeling, such a person has invested a lot into time and effort, into resources. Okay. Now, another thing is that for you to get some very good stuff out there, you must be ready to pay as well. When I say pay with your time and pay with your financial resources. So the journey in learning financial modeling or learning any other aspect for that matter, or learning other skill for that matter, is not actually a destination. It's actually a journey. Okay, it's not a destination, it's a journey. You keep learning every day. So that's just my advice. If you're just starting up, you don't have a background in accounting, that is not a minus. Trust me, it's not a minus. It could be a kind of it's not a minus. You just have start learning. There's a lot of good stuff out there that you can learn, and you can build yourself up in a couple of weeks or even months. Honestly, trust me, you'll start doing very, very well.
Thanks a lot. I've tried to summarize what you said. So as you are saying it, I was writing them in the chat box. So there it is. You heard it from someone who has many decades, not even just years. I don't know whether it's 3 decades or I know it's decades of experience right from the beginning. So it's not like maybe it's like some of us that miswrote the entire year. So, and when he's saying all of this, he's saying what definitely is the gospel truth as regards this. So I've written that. So the last question, sir, is we want to hear your own journey. So everybody we try to hear their own journey. How did you even go into accounting? Has it always been your first choice? And then not just did you go into accounting, you stayed there, you worked in the corporate world as a staff, and then progressed in some of them to management level. Then even when you decided to start your own business, you still stuck to that domain. And many years after, you are still going strong, still learning every day. So what's your story? What's the motive? What's the secret, sir? What's the journey? What's the story? And why that fervency in this?
But thank you very much. When I started out some years ago, I loved accounting. I was working in a foremost publishing firm. That was in I think 93. Okay, that was anyway. It's used to be Longman. Now it's Learn Africa PLC now. Okay, I started my accounting career there. I qualified there, and that was where I fell in love with accounting. I did a lot of stuff in accounting. From there, started doing some other stuff. But I was so myopic then, that's the truth. And that was where I even started using Lotus 123 before we eventually moved to what's called Excel. If I had known then, I would have done a lot of other things. Okay, but anyway, that's a story for another day. So down the line, I was so straight line with accounting and finance. Took me into the telecoms sector, took me into the construction sector, advertising sector, consulting sector. Very, very, very interesting. Okay, and there were things I enjoyed. But until the year 2015, when I actually left paid employment, and I realized my love for accounting was actually I started seeing accounting as something that's a kind of a boring, okay, and my love for analysis then started growing, and I said, come, I love anything analysis. I want to be able to get my hands dirty with analysis, and I think coincidentally that was the year I got introduced to Power BI, and like we used to say, the rest is history. I do less of accounting now at this, except maybe like I have a couple of clients in the East and also in Lagos. We do find that I did accounting system installation and setup for. If apart from that, I do more of analysis and training and financial modeling. Accounting has been very good. It's been a very good foundation aspect in my life or in my career journey. Like it, but like I said, it's not my first love now. Honestly, it's analysis now, financial analysis, working with data, being able to work with data, especially using Microsoft tools to do that. Okay, that is, and I'm working with financial model. I believe working with financial model and doing analysis is a little bit more, to me, is more innovative and dynamic for me now. It's not really that boring for me right now. So that's my journey, and that's my story. I don't know, maybe tomorrow I may actually change to another aspect, but for now I think I'm very, very comfortable, doing a lot of analysis, especially using my newfound love now is what's called a Power Query, and I've been studying that now for almost a month. I've been working on that seriously. I just want to know everything on Power Query. I know it's almost impossible to do that anyway, but I even study Power Query more than what's called DAX or even Power BI itself. I want to be able to do almost everything you can do normally with Excel that hitherto has been very, very, very difficult to do with Power Query. So that's where I find myself now, because I realize it's a world of data now. And 90% of the data you use now don't come in the form that you can actually use, to analyze. You need to get your hands dirty and clean it up and make it useful before you can do your analysis. So it's been from finance, it's been from account to finance to analysis now. Let me say just to data analysis now. Okay, and modeling. So that has been the story. Thank you.
It's nice to hear it today, because even the many years I've known you, I don't think I've heard it in this personal way. I've only known a bit of different aspects of where you worked and your journey. So thank you for sharing. I'm sure a lot of people will take motivation from me. And more importantly, the part where you said that you felt at the beginning, if you are taking the kind of learning approach you are taking now, it will have been really nice, because until you decided to go on your own, you now saw that, there are so many more things that you're now learning a lot more than when you were even. So anybody still in a paid employment, sometimes you might feel like coasting. That's the word some people use. Like, you you are just perfect on all what you do, and sometimes the pressure to learn is reduced. Well, you're hearing it from a veteran who has been across different industries and is telling you in the experience that when he left, he found out that there are so many things that he needs to know, that he felt like learning should be as strong as even any other thing you do in your work. So thank you. I took that one away and I decided I'm going to say it loud and clear for everybody. Keep learning, Don't ever feel like you've known all what you need to know. Even when you feel like that, try and create an environment that will force you to learn more, join people learning. So thank you very much, sir. I know you do many things that some of our participants might need your services on. So is there ways they can get in touch with you? What are the kind of services that they can reach out to you for? So that's our own way of saying thank you. Let us connect you to some businesses amongst the people in here.
Thank you very much, Mike. Well, yes, like I said the other time, I'm the lead consultant at Vine Logic Solutions. The website is there, the contact address is there. We do train financial modeling and business support, okay? Anything that has to do with supporting businesses, creating financial model, training on especially Microsoft-related products. Not all, anyway. It turns us on, okay? And for those who think Excel is exhaustive, then I laugh. But that's a story for another day. There's so much things you can actually do, things that are just out of this world that can blow you off, okay? That you can do with Excel that can make your life so easy. So we do this couple of things, okay? Training, finance related training, in Excel, in data analytics, Power BI, okay? And consulting as well. And also Microsoft 365 installation. We've done that for a couple of our clients, and they're doing very well, which is very, very interesting, installing and activating Microsoft 365 for a couple of our clients. And it's very, very, it's very rewarding, okay? So these are just kind of related services that we do. So you can always reach out to us. You can check out my name on LinkedIn. You can always get across to me for support, or even for business. It can even be for support. Yeah, of course, I'll be eager to lend the help in hand and to help as much as I can. So thank you very much for that. Yes, I really appreciate it.
So I've pasted the website link, and I've also mentioned that they can reach you on LinkedIn by them just searching for your name. I've typed your name in full for them to see too. So thank you to everybody. Thank you especially to our guest presenter today. And I want to say happy Sunday to all of us and those who are interested in the other Excel and Power BI session. Okay, we'll see you again before the end of today. So thank you and have a nice week ahead.
Thank you so much.
Bye.
Thank you so much, and thank you everyone. Okay, thank you so much, Mike. See you later.
Yes.